Okay, recent economic news is causing bond rates in Europe to drop sharply. And since I was just on the topic of negative interest rates, I thought I'd read this article from Sputnik News talking about this. China and the European Union have both been accused of unfair trade practices by the Trump administration, while the EU has started to show signs of economic slowdown as it prepares for a potential no-deal Brexit. Dutch and Irish government bond yields have turned negative for the first time on Monday. Irish bond yields are negative. Like, only 4 or 5 years ago, their yields were like 20%. Things have changed since then. As Eurozone yields plummeted amid the ongoing US-China trade war and rising concerns over a no-deal Brexit, according to London's Southeast. The decline in European bond yields comes after Germany's yield curve turned negative for the first time on Friday. The fall in bond yields comes despite recent reports that the German economy faces a serious economic slowdown and even recession. According to Reuters, investigators are alleging turning to less risky assets. According to Reuters, investors are allegedly turning to less risky assets following an escalation in the US-China trade conflict. Dutch 30-year bond yields fell to a low of negative 0.03%. Okay, that's a 30-year bond yield. I mean, inflation is probably going to be way higher than 1% over that period. So, I mean, in real terms, those yields are very negative. And who knows what could happen in 30 years? Maybe some sort of oil crisis will cause inflation to surge to like 5% for a couple of years. I mean, there's like so much uncertainty. It's just unbelievable interest rates for that long a period are negative. Making the entirety of the yield curve negative for the first time ever. Irish 10-year government bond yields also fell and went negative at negative 0.005%, as investors turned their attention to Brexit and more global concerns. Long-dated bonds maintained a positive performance, while most 30-year bond yields were 5 basis points. Despite being in the grip of political uncertainty, Italian and Spanish bonds also fell by 4 basis points, indicating a potential for Italy's economy to recover. This reflects a rise in business confidence in Italy, according to IHS, Market and the National Statistics Bureau. Well, Italy's economy has been doing like the worst of all of Europe recently, so that's a shift if this is true and holds out. Italy has had a tense relationship with the EU since populist Five-Star/League coalition came to power and introduced budget proposals in breach of EU deficit rules. Despite accusations of artificially devaluing its currency, China allowed the yuan to fall below 7 per dollar for the first time in over a decade. 10-year bond yields also dropped a further 7 basis points on Monday morning to 0.053%. Some analysts say the collapse in yields indicates a decision by the Chinese authorities to invest in bonds rather than U.S. treasuries. The CNY above 7 has triggered more risk-off in global bonds, which is why safe haven bond yields have continued to fall, said Rainer Gutermann, rate strategist at Commerzbank. There is speculation that the PBOC could intervene and buy bonds, added Gutermann. If they were to slow the weakening of the CNY, they would buy treasuries, but the situation they could switch to bonds, he said. Both China and the EU have been the target of U.S. sanctions, with President Donald Trump claiming unfair trade balance between the U.S. and two economic blocs. The Trump administration has threatened to impose tariffs on EU imports, to which the EU has responded by proposing tariffs of its own. The devaluation of the Chinese currency potentially provides an advantage to Chinese producers selling goods in the U.S. So anyway, what's happening is that recent economic events are causing bond yields to fall even further in Europe, and just widening and deepening the phenomena of negative interest rates we're seeing. And that's very interesting. Europe is currently entering a slowdown, and who knows? Maybe things will get better, maybe things will get worse, and one or two more European countries will enter an outright recession. And anyway, that's causing the drop in risk demand and willingness to invest. That's leading to dropping bond yields and interest rates, and so making interest rates negative. If you like this video, please subscribe to my channel, hit the notification bell, like the video, and leave your thoughts in the comments.